Hi, Chris Camburn, 1406 Financial, here with a video on required minimum distributions. These are the distributions that you have to take from your IRA by the end of the year under different circumstances. And so if you're looking for, do I need to take a required minimum distribution, or how do I take a required minimum distribution? This video is for you. Let's run some disclosures first, and then come back and get into things. All right, welcome back. Let me describe who this video is for, who it's not, or what it pertains to, what doesn't pertain to, sources of information, and kind of get into it. So this video pertains to traditional IRAs, rollover IRAs, and we'll touch on 401ks and 403bs. I use the term 401k to describe 401ks and 403bs, so if I say 401k, it could also mean 403b as well. This video does not apply to non-deductible IRAs, inherited IRAs, or Roth IRAs. There's no RMDs from Roth IRAs. Inherited IRAs have to be distributed within 10 years. If you're 10 years younger than the person you inherited from, and if you're a spouse, you roll the IRA into your own. Non-deductible IRAs have this exclusion ratio and these factors based upon what's pre-tax and what's post-tax, and it's just too much for this video. So for figuring these things out, and if you need to make a required distribution, let me just show you my source of information here. It's IRS publication 590B. This is the rule book. Just look up on Google or search for IRS publication 590B, distributions from individual retirement arrangements. The version I have is from 2021. The rules don't change a lot from 2021 to 2022, and what we did for 2021, we'll do in 2022 again, so never mind that year this pertains to. Just look for 590B and generally follow along with the rules. So the first thing is, by when do you need to take a distribution? All right, that's known as your required beginning date. So your required beginning date used to be, we knew the number 70 and a half, right? For the longest time, it was the April 15th of the year. After the year, you turn 70 and a half, and you're doing this calendar math. So now they've made it, the new rule is April 1st of the year, after the year you turn 72, and then by December 31st each subsequent year. So let me say that again, and let's bring up a calendar to go through it. April 1st of the year, after the year you turn 72. That's when you have to take your first distribution, and then by December 31st of each subsequent year. So bringing up the calendar that I created for this. All right, so if you're turning 72 this year, 2022, or if you have turned 72 this year, you need to take your required distribution by April 15th of 2023. That's the deadline for taking it. Now, you can take it sooner. For instance, you can take it by the end of this year. You can take it anytime this year. You can take it anytime next year up until April 15th. But that's the deadline. But the reason you might want to take it by the end of this year is because your required distribution is based upon your 2021, your previous year's year-end value. So you take all your IRAs, you add it up, and let's just say all your IRAs add up to such an amount that the distribution is going to be $25,000. Now, you don't have to take that by December 31st of this year. You can wait until next year, until first quarter next year to take it. But keep in mind, if you wait and you take it here, you're also going to have your distribution from 2022 factored into 2023. So it's going to be, you're going to have two times the distributions in one tax period. So by not taking monies this year, you're moving your distribution to next year. And then next year's distribution, you don't get until April 15th of 2024. You have to take your distribution by the end of next year. So you could have two distributions in 1 year. Now, if you have a lot of income this year, that might make sense. But if you don't expect your income to change too much, you more than likely want to take your distribution by the end of this year. So one distribution this year, one distribution next year, again, instead of lumping two distributions into 1 year. So your required beginning date is April 15th of the year after the year you turn 72, but you may not want to wait because that would entail you doubling up on distributions in that next year. Now, how do you calculate your distribution? Well, using that IRS publication 590, let's go back to that for a moment. Erase. So how to calculate how much, I think they go here by how much do I need to distribute. I think that's what the kind of quick question is. But publication 590, figuring the owner's required minimum distribution. So they have these things called life expectancy tables, and required minimum distributions during your lifetime are based upon a period that's generally in this Table 3 Uniform Lifetime Table. So this table is to be used for unmarried owners, that means if you're single, married if your spouse is not 10 years younger, and married owners whose spouses aren't the sole beneficiaries of their IRAs. Okay, most people use this table, and so in the first year, you're 72, it's a divisor. It's not an interest rate. The divisor calculates a rate of interest or an effective distribution percentage, but the IRS uses this table and these factors. So you divide your IRA by 27.4, and that comes out to a 3.65 distribution rate. And over time, as you can see, as these factors increase, or actually as the factors decrease, it essentially translates to an increase in the interest rate and the amount that you have to distribute from your IRA. So it's on this publication 590B. You can find this, what they call a distribution period. And so the prior year, December 31st, you divide your IRA, all your IRA account balances, you add them up and you divide them by your factors. So if you're turning 75 this year, you divide all your balances from last year by 24.6. If you're turning 80 this year, you divide all your IRA balances by 20.5. Now, on this point, I should mention that you can aggregate. Let's get over here for a sec. You can aggregate, well, you have to aggregate all your IRA account balances, but for the distribution, say you have 3 IRAs because you have 3 different investment strategies, and again, your distribution is going to be $25,000. You can take $25,000 out of one IRA. You can take a little bit out of each IRA, so it adds up to $25,000. So you have to aggregate your balances, and you can then redeem from 1, 2, or 3. It doesn't matter. Side note with 401ks, if you have a 401k and an IRA, or a 401k and 2 IRAs, or 2 401ks and 2 IRAs, each 401k has to have a distribution taken from it. So 401k 1, you got to take money. 401k 2, you got to take money. Then your IRAs, you can consolidate and take monies out of one. But each 401k has to have a distribution. So if you have a big IRA and a small 401k, just don't go taking out a lot from your IRA thinking your 401k is covered. No, you have to take monies from each 401k individually, where IRAs, you can take monies from IRAs in aggregate. Now, something that might be helpful if you're charitably inclined. Once you're 70 and a half, you can start making qualified charitable contributions, or qualified charitable distributions, I should say, from your IRA. And what this means is once you're over 70 and a half, you can give monies from your IRA directly to a charity and not have it be counted towards your personal income for the year. And this is a good thing, because when you add money to your 1040, when you add money to your income, it affects all other sorts of tax rates. It might affect your income-related Medicare adjustment. So once you're 70 and a half, it can be very helpful to gift monies directly from your IRA to a charity. And if you do that, the limit's $100,000. If you're inclined to give monies and you're over 70 and a half and you don't give monies directly from your IRA, I mean, it's fine. I'm not telling you have to do this, but I'm just showing the effects. If you take monies from your IRA and you pay yourself, or take possession, receipt of those funds, and then you write a check to your charity, there's a little bit more paperwork. You have to add those IRA distributions to your 1040, then you can deduct it, right? Still tax deductible, but it adds to your gross income for the year, and this may have an impact on other taxes you pay. So it can be very helpful to give monies directly to a charity from your IRA. And also a limit of $100,000 versus here you're limited to 60% of AGI. And further, if you may not even get a tax benefit, because if you're, let's just say you're under 70 and a half, so there's no forced distributions here. If you just give $10,000 a year, right, to a charity, well, standard deductions right now are coming close to $28,000, I believe, for a married couple. So you're going to take a standard deduction of $28,000, and you're not going to get the benefit of this $10,000 charitable contribution. Now, if you're itemizing, you will get the benefit of this. If your itemized deductions are above $28,000. But if you're taking standard deductions and you send that $10,000 right from your IRA to the charity, wow, then you still get the standard deduction and you never pay taxes on that $10,000 to the charity. So this is a helpful method of gifting monies to charities. Now, if you're over age 72 and a half, and let's say you want to give monies to a charity, and let's say your required distribution is $25,000, and you want to give that straight to a charity, that's fine. You can certainly do that, but the required distribution amount of $25,000 is not avoided as being taxable, right? So if your required distribution is $25,000, you're still going to be charged, and you take monies out of your IRA, you're still going to be charged taxes on $25,000. So you're still going to pay income tax on it, but you can make it a little bit easier by just sending it directly to the charity. Now, if you take more, and let's say your required distribution is $20,000, but you send the charity $40,000. Well, you can send them $40,000. It satisfies your $25,000 RMD. And if you send that $25,000 directly to a charity, or the $40,000 directly to a charity, only $25,000 gets reported as taxable income to you. The other $15,000 from 25 to 40 avoids going on your 1040. And again, this is helpful for ultimately reducing your gross income for the year. Still, $100,000 limits apply when you take it directly from your IRA to a charity, and there's still the 60% AGI limit, right, if you're the one writing the check to the charity. But it's just helpful to avoid it being included in gross income. It makes it administratively easier. So making qualified charitable distributions might be helpful for you. Lastly, mutual funds. If you're a mutual fund investor, you know that every year mutual funds pay off those pesky distributions. And so you might want to wait for your mutual fund to make the distribution before you distribute a mutual fund from your IRA. You can distribute cash from an IRA, or you can distribute securities. Securities means stocks, bonds, or a mutual fund, or some other IRA eligible investment. So, oftentimes folks distribute cash just to make it easy, but if you don't have enough cash and you want to distribute a mutual fund, that's certainly a way to go about it. You may just want to wait for the mutual fund to make all their year-end distributions first, and I'll show you why here. Let's say that your RMD is going to be $25,000, and you're in a 24% tax bracket, so it's a $6,000 tax. You'd net $19,000. Now, you have $19,000 in your taxable account of that mutual fund. It pays out a 10% distribution. Hear me now, 2022 is going to be a very, very ugly year for these mutual fund distributions. I just think mutual funds are going to have to pay out more than in past years. Just the way mutual funds work, they have to pass out 90% of capital gains incurred throughout the year. This was a down year. There's been a lot of redemptions from people. I bet there's been a lot of trading in mutual funds. I think there's going to be big distributions this year. So if you have this is a hypothetical example. $19,000 of a mutual fund pays a 10% distribution. It's called phantom income. You don't get $1,900 more of a mutual fund You get a reduction in share price, but you get more shares, but your net money is the same. $19,000, they pay 10%. You still have $19,000 to the mutual fund. And you get this phantom tax bill, could be $285. That's 15%. Assume it's all long-term capital gains. So you might get this other little tax bill. Not that that's going to crush you, but it's just something else to deal with, right? A little nuisance tax. When had you waited for the fund to make its distribution inside your IRA, there would have been no taxes on the 10%. You distribute $6,000, you net $19,000. No additional distributions, no additional taxes due. It's a $285 benefit in this example. I mean, not huge, but I think on principle of if you have to take money out, let's take it out after they make those distributions, not before. If possible, I mean, if they're making these distributions too late in the year, you might not have processing time. But if you can possibly avoid these distributions outside of your IRA rather than inside your IRA rather than outside, you might be better off. So let's go back to my cover sheet where, let's see, so we were talking about who needs to make required distributions, required beginning date, the tables to use, how to calculate them based upon your year-end, the prior value divided by the factor in the table, qualified distribution, benefits, and maybe waiting for these pesky mutual fund distributions to occur first before making your distribution. So, in summary, I hope this video is helpful in explaining who needs to take required distributions, when to take them, and they continue for every year after you're age 72. And you can always take more. There's a penalty if you don't take enough, but those are required minimum distributions. You can always take more. And also I've written some guides, tax tips, serial conversions, topping off your tax brackets. I'll put links to these in the bottom for strategies for why you might want to take more out of your IRA than the required minimum. Those will be some further readings, and I created some videos on those too. But anyhow, I hope this helps. You understand who needs to take distributions, when to take them, how they're calculated. Thanks for watching. See you back here soon. Thank you.